Good morning, everyone. Happy Friday.
Good morning, Anna.
Friday here with Jim and Anna. Good morning, Jim.
Hi, how are you doing?
I'm doing fine. I like your background.
Yes, I'm at what we'll describe as an undisclosed location.
I
I'm
know.
actually at a client's residence here out in California where it's been pouring rain, but the sun is out at the moment.
Cool. Okay. Well, don't get too cozy up there by the fireplace because we have some questions that we need to answer. So,
You bet.
a couple of announcements. While you guys watching this recording, you can, while we're still on and the show is going on, you can ask us questions. And so on the left-hand side of your little screen on the Google channel, there's a box that says submit a question. So if you're watching it live and have a question, we'll be checking back to see if there are any, and we're happy to answer those.
Right. And we want you to make them really hard questions because Anna's going to answer them today.
Yes, put Anna on the spot, as
Right.
Jim likes to do. So, well, since you're being so nice to me today, why don't I put you on the spot? Can I do that?
You certainly can. Go ahead.
Then I'm gonna ask you first question.
Okay.
Okay. So here's our first question. It's a bit lengthy, but here it is. Our daughter will be attending college starting next fall. We have been trying hard to save for retirement in college and have come up short in our 529 plan. Only saved $50,000. We have other assets we haven't originally intended to be used for this goal, but now wondering if it makes sense to borrow money instead.
Well, this is a frequent question that we get asked, Anna, and so I'd like to answer it this way. There are many federal and private student loan programs, but there's two alternative sources of funding for college that we frequently observe, sometimes we recommend, and that turns out to be a home equity line of credit or a 401k loan. Now, the max of a 401k loan is, you know, and I know, but other people may not realize, is $50,000 as long as you have a $100,000 or more balance in your 401k. The downside to that is that you have to start paying the loan back starting the next pay period, and the loan's only going to last 5 years. The good news is the interest that they charge you on the loan, guess where it goes?
It goes back into your pocket.
Exactly. So you become your own lender. So although we're not really excited about people using their retirement assets as sort of a security for a loan, this is a good use rather than saying disposing of taxable savings that might be intended for car purchases, other household needs, or for retirement. The second alternative source is a home equity line of credit. Most people are familiar with that. They know it's a variable loan. They know that they have to pay it back over time, usually about 15 years for the ones that are being issued today. It is a secured loan. In fact, both the 401k and the home equity line of credit are secure loans, whereas most of the other kinds of loans directed for college are unsecured. It's the people's promise to pay, but the lenders usually have a number of resources to go after you, and you can't discharge student loans in bankruptcy. So that's another issue to kind of keep in your back mind, not that we have many people that go through bankruptcy or that even consider it, but it is a point to remember. So usually home equity line of credit interest rates at the moment here at the end of 2014 are lower than the 401k loans. The home equity line of credit loans are variable. And so when we think about what the Federal Reserve might do next year and rising interest rates, that is a risk. So if people feel that there's a parental obligation to pay for college, then we really recommend they use their 529 first, followed by a 401k loan, followed by a home equity line of credit loan. And then we really encourage people to pay back those loans quickly, or they could end up delaying their retirement. How's that for an answer?
That's good. What about putting a little bit of pressure on the student? I'm trying to defend the parents a little bit. So.
Well, defending the parents, it's hard to overcome love when you really don't want to saddle your children with a large amount of debt as they graduate from college. And that's a common goal for parents that we're meeting with. Not everyone agrees with that, but many do. And in the case of this client who's writing that question, that is one of their motivations. So they would rather take on debt and have a larger capacity to extinguish that debt in a shorter period of time than their daughter might.
Okay, but also a little bit of skin in the game makes it a whole lot of difference for the students. I know this from my own experience, so no, I certainly understand the concern of parents. So, okay.
Well, speaking of concern, Anna, one of your clients was concerned and wrote in a question, a very long question, and I'm afraid this is going to be a long answer, but it's a short question. How much money should my partner and I spend on disability and life insurance?
You want to give a little bit of a background on this?
Okay. For example, what percentage of one's income should these expenses be kept under? My partner and I are in the market for 30-year term life insurance policies, a supplemental disability policy that might make up for any shortfall in our work benefits, both for retirement income savings and for loss of work wages. We've obtained several estimates. It seems like carrying full coverage for all these things will put us far outside of our $5,000 a year budget for insurance. How do we scale back coverage? And if so, what items should we reduce or eliminate?
Okay, so I'd like to answer this in two parts. First, the disability insurance, and then life insurance. So with the disability insurance, for this particular couple, their estimate for the premium was $4,400 a year. So I looked around because one of the first questions they have is what percentage of their income they should allocate for all kinds of insurances, and they have $5,000 is sort of the number. And when I looked around to see if there's any guidelines, so here's what I found. Men typically spend 2 to 2.5% of annual salary, and women tend to spend more, or it costs them a little bit more, so 3 to 4% of annual salary. So if I looked, and I don't know what each of these people make, but their gross annual income combined is $225,000. And so if we took an average of what men and women should allocate for disability, let's say it's 3.5 average number. So then 3.5% of $225,000 gross annual income comes up to be about $6,700 per year. So it's actually a little bit more than what they have obtained quotes for. So it seems to me, if we're looking at this from the standpoint of how much should we allocate, and if we follow these guidelines, then the quotes that you already have seem to fall within those guidelines. The second piece to this question about the disability, if we're trying to keep our costs under control, so then let's take a look at the riders that these supplemental policies are offering you, because that's probably one of the ways we can scale back a little bit on the coverage. So for example, if you have a retirement plan contribution rider, as you mentioned, that would be a place to start and see if we can reduce the coverage. But just looking initially at this, it doesn't seem like the quotes that you have are on the higher end of things. Okay, Jim, is this clarified enough?
Well, and so you covered life insurance in that question too?
Should I ask you a question, or you want me to continue? Well,
why don't you go ahead, because That's a two-part question. You've dealt with disability. What's your recommendations for the life insurance?
Okay, so life insurance. Okay, we have, so these folks are looking for a 30-year term, $1.5 million, I suppose $1.5 million each. And so the premiums that they've obtained quotes were together about $3,000. Okay, so that's the background. And again, also knowing from just the experience of seeing what our clients get and the kinds of premiums they pay, just initial look at the cost doesn't seem to be high. First of all, because it's a 30-year policy for $1.5 million, for a premium that's about $3,000, that doesn't seem initially to be high. So one of the ways that you could try to scale back on the cost, not necessarily the benefit, is maybe to ladder the policies. So there's a concept of laddering CDs, and we all know that, where you have CDs maturing at different dates. So this same kind of concept can be applied to having multiple term life insurance policies, where one has a shorter maturity, one has a little bit longer, and so forth. So you stagger them to cover the period of time where you need the coverage the most. So for example, if you're starting out a family and you have a mortgage that you have to pay off, or so something like that during those peak years where you need to have the most coverage, so you have those policies overlapping, and then and sometime in the future, let's say 10 years, one of those policies will fall off. Then in another 5 years, another one, and then maybe in another 5, another one fall off. So eventually you're going to have a little bit of insurance left, but one of the other advantages is if you're getting this insurance now while you're young, you lock the premiums because they're lower. So think about doing something like that. And one of the seminars or webinars I attended earlier on this concept from a company that we actually like to deal with, Low Load Insurance Services, they mentioned that. So for example, if you're comparing the 30-year policy with, let's say, 2 or maybe 3 policies. One is 10-year, another one is 20, and the third one is maybe 5 or 2 5-year policies. Then the cost for those laddered policies tend to be a little bit smaller than for example, if you just got one big 30-year policy for $1.5 million. So if we're looking at reducing the cost, that would probably be one way to figure this out. I wouldn't go for reducing the benefit because, again, trying to save a little bit on premium might be a good idea, but looking into actually what you're covering and comparing the two, I think it's better to have more benefit and try to work out the premium. So that is what I have, Jim, so far.
So you might have a 500,000 10-year, 500,000 20-year, and a 500,000 30-year. That would be kind of an example of a ladder.
Right, or maybe $1 million policy for 20 years, and then maybe a 10-year for 500, and then another one for 500, like for 10 years. So then they overlap maybe for the 10 or 15 years that are really critical in your life, where you need to have the most coverage because you have family and other financial obligations.
Right.
So, okay. Are you ready for your next question?
Yes, that was a long answer to a long question, so that's good.
I understand. Okay. So here's your question. Yours is short. So, how do I know when my bond fund is going to pay dividends?
You know, that's a really good question. That's what you always say, and of course,
yes, did you notice?
Really good question for me to answer too, because it was just asked just the other day. Mm-hmm. And actually, you know, bond funds pay interest rather than dividends, but it's easy enough to call them dividends if you understand it. Usually, you'll find the payment listed on the back of your brokerage statement or your fund statement. Usually, it has the holdings on the first part of the statement, and then if you go back through a number of pages, you'll see these transactions. And if it's a quarterly statement, you might see 1 or 3 different deposits from the mutual fund company if it was a bond mutual fund. You can also do some research on past history by going to a free website at morningstar.com, and on the front page towards the bottom it'll show the distributions over the last year. And in the bond fund that was under question for this question, I saw that there was they did it every month, and there was one capital gains distribution too, which means they must have sold a bond at a profit, and then they shared that profits with all the shareholders. So that was really nice. Mm-hmm. You can also go to another website called Zacks.com and find similar information. I usually go to Yahoo Finance because you can find the historical return and the interest income and appreciation, because some funds, even bond funds, appreciate or depreciate. And by the way, many fund families publish a schedule of when their interest and dividend payments are going to be expected. I know Vanguard does, because we have a lot of clients with Vanguard and we get those notices all the time. So I would advise people just to go to your fund home website and look for the details there. That's my answer.
Very good. It doesn't seem like we have any questions from the audience, so we'll just have to Okay, Jim. Well, here we go. I am ready for my vacation.
Anna.
So I'm not taking any more questions this year. Sorry, I wish they had a little bikini here, but they don't. So anyway, Google Hangout.
Okay.
Well, I want to wish everybody a very happy New Year and Merry Christmas, because we won't be back until January of next year.
And
I think we've had fun doing this. So we've done 8 episodes this year, and looking for more next year.
Right, and I hope I can transmit from an undisclosed location like this in the future. It's really nice and warm on this cold winter day.
It is. Well, now you can go and snuggle next to the fireplace.
Will do.
Since the show is over. Okay, we're out of time. Again, happy holidays, everyone, and stay in touch.
Bye, everybody.
Bye.